All right, what about those interest payments, the debt tax shield, and the financing risks, you ask? Well, the first two are easily built into cash flow generation. If the company didn't have to make interest payments on the debt, cash flow generation would have been higher. So you create a negative value driver for the after-tax interest cost, and then you can add it back to cash flow generation to create an unlevered cash flow generation measurement. Now, this is really just a cosmetic thing because they add up to the net debt change. And in my opinion, that's really a better way of looking at it. That's the number that's downstream from all the GP's decisions about debt levels and interest rates. Now, to get the financing risk, you need to look at the gearing term that we described in the last two videos. You can do this first by unlevering the EBITDA growth and multiple expansion by multiplying them by the average holding period equity ratio. This corrects the performance value driver and the valuation value driver for leverage, but it also leaves us with a hole in our value bridge. That hole is filled by calculating the deal's gearing, which is the product of the enterprise valuation change and the average holding period debt ratio. As we described in the last two videos, this measures how much extra equity was gained or lost because there was debt in the capital structure, the amplification of equity gains or losses. Or in a growth deal, it measures the drag on equity value change because there's excess cash on the company's balance sheet, the dampening of equity gains and losses.